Hey everyone, Longacres Finance here with the Quality Dividend Stock Watchlist for January 2021. Nothing like a brand new year to jump into the market. Forget about what happened last year. That's all in the rearview mirror now. Maybe you made a boatload of money in the stock rally. Maybe you missed the boat sitting on the sidelines. Either way, you can't go back and change what happened, so it's time to look forward. Using a set of criteria, I track a watchlist of quality dividend stocks that should be safe, reliable, and growing investments for the future, all the while offering investors an income stream. The quality dividend stock list places no emphasis on yield, but rather focuses solely on quality businesses, with an emphasis on valuation using the dividend yield theory. I'll talk more about the valuation process later. If you're seeking high yield stocks, check out my other series using the link above. That watchlist has slightly looser criteria, but only contains stocks that offer a dividend yield of 2.75% or higher. The quality watchlist should offer a higher total return, while the high yield watchlist will generate more passive income. You should decide which option suits you better or blend them together. The quality watchlist for January 2021 is made up of 24 individual stocks. Here they are in alphabetical order: Accenture, ADP, Bank of New York Mellon, BlackRock, Comcast, Domino's Pizza, Fastnell, FactSet Data Research, Graco, Home Depot, Intuit, Jack Henry & Associates, Lockheed Martin, Moody's, MSCI, Microsoft, Northrop Grumman, Northern Trust, Roper Technologies, T. Rowe Price, U.S. Bank, Visa, West Pharmaceuticals. Two stocks have been removed from the prior month. Costco and MasterCard are no longer on the list. And the one new addition is the return of Moody's, which was on our original list from September 2020. If a stock is dropped from the watch list, I don't sell that position, but simply do not add additional capital to the position. I am a buy and hold investor because it lowers my tax liability, and some of my worst trades in the past have been selling too early. To each his own, and you should do what's right for you. 7 of the 24 stocks on this month's watch list are potentially undervalued, with an additional 3 positions fairly valued. I use the dividend yield theory to value stocks. The process is simple. You compare the current dividend yield to the historical yield, and if the current yield is greater than the historical yield, the stock is potentially undervalued, and vice versa. I consider stocks that are within 5% overvalued to be fairly valued. Like all valuation methods, this is just an approximation, as it does not consider any fundamental analysis. There may be underlying reasons why a stock is currently undervalued. They may be related to the business, the industry, or the state of the economy. It is up to each investor to make that judgment call for themselves, so I encourage all of you to do further due diligence on all the stocks on my watch list. Let's go through each undervalued and fairly valued stock on the watch list, and then I'll talk about historical performance of past watch lists, and show you the new mock portfolio that will track my watch list starting in 2021. Please help me grow my channel by liking this video. My current record is 5 likes on a single video. Let's see if you can help me break that record. Also, please subscribe to my channel to be notified of future dividend stock updates. Okay, the first undervalued stock is ADP, and it is currently about 4% undervalued, with a dividend yield of 2.14%, compared to its historical yield of 2.05%. The next stock is Bank of New York Mellon, and it is about 60% undervalued. It currently offers a 2.97% yield, and its long-term historical yield is 1.86%. The next stock is Home Depot. It is about 11% undervalued right now, with a dividend yield of 2.26%, compared to its long-term yield of 2.04%. The next stock is Lockheed Martin, which is also about 11% undervalued, with a current dividend yield of 2.94%, compared to its historical yield of 2.66%. The next stock is Northrop Grumman, which is about 22% undervalued, with a current dividend yield of 1.92%, compared to its historical yield of 1.57%. The next stock is Northern Trust, which is about 59% undervalued, with a current dividend yield of 3.05%, compared to its historical yield of 1.92%. Interesting fact, this is only the third time since 1990 where Northern Trust's dividend yield climbed above 3%. The last undervalued stock is U.S. Bank, and it is about 53% undervalued. It currently pays a dividend yield of 3.64%, compared to its historical yield of 2.37%. Comcast is fairly valued at the moment with a dividend yield of 1.8%, compared to its historical yield of 1.81%. Jack Henry & Associates is also fairly valued with a dividend yield of 1.08%, compared to its historical yield of 1.09%. And the last fairly valued stock is Visa, with a dividend yield of 0.59%, compared to its historical yield of 0.61%. Collectively, all the stocks on the watch list have an average dividend yield of 1.6%. The fairly valued and undervalued stocks have an average dividend yield of 2.24%, offering a bit more of an attractive yield. The criteria for inclusion in the watch list is a market cap above $10 billion, payout ratio below 70%, a wide moat, an exemplary or standard management team, an A- or better S&P rating, a medium or low volatility outlook, a growth rate of at least 5% for the past 5-year dividend stream, revenue, and earnings per share. Let's take a look at the past performance of the watch list. For December, the watch list returned 2.99%, while the fairly valued and undervalued stocks returned 2.35%. Vanguard's Dividend Appreciation ETF, ticker symbol VIG, was up 2.52%, and the S&P had a total return of 3.84%. Since inception, September 2020, the watchlist is up 6.27%. The fairly valued and undervalued stocks are up 6.8%, VIG is up 9.09%, and the S&P is up 7.66% during the same period. Thus far, we are trailing VIG and the S&P, but I have a long-term outlook on the watchlist, and I will give it time to pay off. Some of the more significant returns in December came from Bank of New York Mellon, which was up 8.49%, Graco, which was up 6.81%, Intuit was up 7.91%, MasterCard was up 6.07%, MSCI was up 9.06%, T. Rowe Price was up 6.21%, and US Bank was up 8.8%. Starting with January, I have set up 2 mock portfolios on Seeking Alpha to track the performance of the watchlist and the fairly valued and undervalued stocks. Each month on the first trading day, I will invest $1,000 equally split between all the stocks. This will be a useful tool that I can use to show you guys the hypothetical return of the watchlist. It will allow me to better track the true return of the fairly valued and undervalued portfolio as the stocks included each month change. But early investments still reap the rewards of future returns, which is very difficult to compute without a mock portfolio. Here's what that portfolio will look like, but you'll get a better look at it in next month's update. Let me know if you are currently invested in any of these stocks in the comments below. Thanks for watching. See you next time.